Good morning, everyone, and welcome to Openpay's H1 FY21 results investor briefing. My name is Jane Lowe and I'm the Managing Director of IR Department, and it's a pleasure to have supported Openpay with investor relations through what was both a strong and exciting half. Thank you to all who've made time to join this call where we will discuss the results for the half year ended 31 December 2020. Presenting today will be Group CEO and Managing Director, Michael Idle. Good morning, Michael. CFO, Jussi Nunes. Hi, Jussi.
Good morning.
And US CEO and Global Chief Strategy Officer, Brian Schneiderman. Morning, Brian, or afternoon for you. Michael, Jussi and Brian will talk to the key highlights of the presentation that was lodged with the ASX this morning. The formal part of this session will be followed by Q&A. If you'd like to ask a question, you can do so at any time by entering your question into the Q&A function below. And as always, we'll get through as many questions as we can in the time that we have. I'd like to now hand over to CEO Michael Idle. Thank you, Michael.
Thank you, Jane, and good morning, everyone. Thank you for making time to attend today's half one FY21 results presentation. I know you are very busy because it has been a strong reporting week, but I hope it's worthwhile having dialed in here and following our presentation today. I want to focus on the execution of our growth strategy, which we outlined when we became a listed company in December 2019, and our excellent business performance in the first half of FY21. I will use our investor presentation to highlight our main achievements for you who are online and look into the video screen. Starting with page 6 of the presentation, which will be the leitmotif of today's explanations, the delivery on our high growth strategy. First, the record growth across our leading operating indicators and key financial metrics. Second, the ever increasing love and loyalty of customers to our differentiated product. Third, our unique market position as a smart budgeting tool in our main verticals, auto, health, home, and increasingly memberships and education. Fourth, our exponential growth in the UK, building a solid foundation to expand into auto and health, which is work in progress. And finally, our bold move into the US with a strong focus on our differentiating verticals, leveraging strategic partnerships to scale quickly. So now over to page 7. Let's dive into some numbers which have been very pleasing. Active plans up 230% to 1.45 million. Active customers up 123%, another record growth, to 461,000. And active merchants up 46% to 2,800, all versus half one FY20. These strong operating metrics have translated to almost a 100% increase of total transaction volume, TTV, to $165 million, and to revenue of $13.4 million, up 63%. This growth acceleration has continued into the second half. I still often get the question, what differentiates Openpay from our main competitors? Page 9 gives the answer at a glance. On the left, we offer longer term, larger value, flexible buy now, pay smarter plans from 2 to 24 months and up to $20,000. And secondly, our B2B product, OP Pro, or formerly Openpay for Business, which is a fully digitized software as a service platform, which we have rolled out with Woolworths and their business customers to start with. On page 10, you find a bit more graphical illustration of our differentiated buy now, pay later product. Many of our competitors, this is what you see on the left, operate in the pay in 4 space, providing what is essentially cost-free short-term credit for t-shirts and tennis shoes and the like in fast-moving retail. Openpay is positioned as the budgeting tool to use for life's more important purchases and experiences. Across meaningful areas of your life: pets, medical treatments, your son's braces, your daughter's soccer club membership, dad's unexpectedly expensive car service, mum's evening classes in accounting, and the refurbishment of the family's home. We are proudly empowering finance-savvy people to be smart about their money and spread payments over a longer period of time. Now a few more insights on the excellent growth during the half one FY21 period. On page 14, active plans have seen massive year-on-year growth of 213%. I just want to make 3 call-outs. Whilst we had a huge spike in retail pre-Christmas, the increase in plans in auto at 41% and health at 66% have also been surprisingly strong, despite the challenging year with lockdowns in these mostly bricks and mortar businesses. Second, we originate less than 10% of our TTV with 2-month plans, even in retail, with its typically lower value products. 71% of the book sits in the 3 to 5 month plan bucket, where we receive fees from the merchant, but also from the customer, that contributes strongly to the commercial viability of our buy now, pay later offer. And third, what you can see here, the age cohorts between 32 and 52 years are our most engaged customers, with between 3.5 and 3.5 plans per customer, often in multiple verticals. We grew our active customers by 123%, as you find illustrated on page 15. Getting now very close to the 500,000 customer mark, which is fantastic. A key takeaway here for you is the strong customer engagement and loyalty, with repeat customers of 86% in Australia and already 66% in the UK. Interestingly, the longer our customers are on our platform, the more regularly they use us. An example, a customer who came on board in 2015 had an average of 1.5 plans with Openpay in his or her first year. 4 years later, in 2020, the same customer had an average of 4.8 plans with us. This is very different to some of our competitors, whose customers tend to spend strongly in their first months, but then fade away quickly. The number of active merchants, over to page 16, has seen a strong uptick. Whilst we had a 35% year-on-year growth of merchants in Q1 FY21, this metric has gone up to 46% for the half year. Why? Whilst we continue to focus our sales efforts on large enterprise and aggregators to scale more quickly, our new automated self-service program that launched in September has made it much easier for smaller and mid-sized merchants to sign a deal and get onboarded with us. It's also quite impressive how strongly we are represented across Australia in health and auto, making 80% of our distribution, where we enjoy higher margins and lower losses from fraud and from credit risk. Flipping now over to page 17. The UK, our first international market, where we have been operating now for 18 months, continues to ride record growth numbers. Year on year, active plans have been up more than 1,000%. Active customers up more than 540%, based on very strong usage at major retailers, the Hut Group and JD Sports, plus numerous other mid-sized merchants across a vast range of categories, from luxury goods to Premier League football clubs. We are strongly progressing our launch efforts into auto and health, with an expected go live in the course of this half year. Feedback from our customers and the market is important to us. In half one, as you see on page 18, our customers expressed their trust in our responsible product with top scores from Trustpilot, where we have the highest in the buy now, pay later market in the UK and the second highest in Australia. On page 19, you find a lot of interesting facts and figures about the Openpay customer community. It's made up of a whole mix of people, including parents, home, car and pet owners, who are typically digitally savvy and financially smart people. 2/3 of our customers are female. And the older people are, the higher their average transaction value is. In our verticals, our customers use us most for products and services between a $700 ATV in auto for things like car servicing and tires, and $3,600 ATV in home. Think kitchens, blinds, and flooring. As you can see on the pages 20 and 21, our customers find us increasingly at leading merchants across our verticals, like Officeworks and Ford more recently. And increasingly, merchants can provide their customers with access to Openpay plans through e-commerce and managed software platforms like Pentana, which went live this month, which gives us very strong reach. Now over to page 22. Our most significant innovation, our software as a service platform into B2B, Openpay for Business, or now OP Pro, started to create commercial value in H1 FY21. Since September last year, we have onboarded a significant number of Woolworths business customers. We are now processing their purchases, and this will result in increasing revenue for Openpay. We are right at the start of what OP Pro can deliver to a market which is many multiples of consumer buy now, pay later. The pipeline for further enterprise merchant deals for B2B is maturing, and we have invested in new people to specifically move this product along. Also, on the back of Austrade's Accelerate program to support high-growth Australian companies abroad, we have started to be introduced to enterprise merchants across Asia, Europe, and North America. Over to page 24, which I want to touch on only very briefly. I already alluded to our launch plans into the UK verticals, auto and health, based on an FCA credit license, which we expect to come through over the next 1 to 2 quarters. The highlight for us in H1, however, has been the announcement of our imminent launch in the US market, the largest global retail and consumer market, around 30 times the size of the Australian market. Openpay has been able to attract some extraordinary talent and experience in the US, including Brian, our new US CEO, who is now building our US team. And I will leave it with Brian to provide an update in his section. Okay, so far to the business update. Just briefly on page 26, I want to address an important point, which in my view will change the dynamics in buy now, pay later quite significantly. There has been a recent shift in the perspective of regulators on our sector, led by the FCA's Woolard review in the UK with regard to customer protection. Customer centricity and responsibility are core to our business, and we ensure as part of our DNA that our products are designed to be beneficial and fair for consumers, providing flexible plans with no hidden catches. For us, increasing regulations will not shrink the buy now, pay later opportunity, but differentiate our responsible product from our competitors. To conclude, we have been extremely happy with the company's strong strategic development and operational performance in H1 FY21. We have made substantial progress on our goal to create a great business and company. And we have done this in line with our vision to change the way people pay for the better via the core pillars of our growth strategy. We are hugely encouraged by the excellent growth rates of our leading indicators in Australia and in the UK, and the positive ratings and feedback we get from our merchants, our partners, and consumer customers. I will now hand over to our CFO, UC, who will discuss our financial position in more detail. Thank you.
Thank you very much, Michael. Good morning, everyone. So following on from our most recent quarterly update, what I'm going to do today is really to quickly recap the main portfolio drivers for the first half of the 2021 financial year, after which I will walk us through the key components of the financial outcomes, or our P&L, our portfolio performance, including losses, our funding position, our balance sheet, and cash flows in general. So starting with recapping performance highlights for the half from page 29 of the investor presentation. Thank you. TTV of 165 million grew by 96% against the prior comparative period, or PCP, which was incidentally the same rate of growth recorded for the second quarter. And on the back of that record TTV growth, our receivables book also grew by 54% against this time last year to end up at 61 million for the half. On the revenue side, total income for the half of 13.4 million translated into a margin as a percentage of TTV of 8.1%. This compares to income of 8.3 in the first half of FY20 with a revenue margin of 9.8, and represents really the shift toward the retail vertical spend that we witnessed in the first half of this year quite strongly. However, the gross revenue yield of Openpay really remains the highest in the market, which we can compare to 4.3 and 6.7% of our two main competitors recorded for the first half. And we remain very pleased by these healthy margins. And then finally, the point I wanted to make there on that performance highlights page was the net transaction loss rate, again, of TTV for the half was 2.3%, which is up 60 basis points, which meant that our net transaction margin, or NTM, was 1.4 for the half. And this dynamic really represents the fact that the second quarter was really heavily skewed toward retail spend, including somewhat lower margin, with a reversion to higher margin TTV in quarters 3 and 4 expected. And in fact, this trend of ongoing margin improvement has already continued through January and February. Okay, so if we go to our financial results on page 30, please, and noting the revenue and loss numbers that I just mentioned, the group recorded a first half EBITDA loss of $21.9 million and a net loss before tax of $25.5 million. Now, this result is fully in line with the group's expectations and again reflects the stage of growth OpenPay is in. Notably on this page, the operating expense growth side, it's worth noting that receivables impairment growth expense grew in line with portfolio requirements, translating into an overall charge of $5.8 million in the half. And this impairment expense for the half represents a ratio of 3.5% of TTV, whereas it was 3.6% at the same time last year. So quite stable and nice there. Employee benefits expense and marketing costs of $11.6 million and $3.9 million respectively grew in response to investing in growth capability of the business. Okay, then to page 31 and reflecting on the portfolio's loss performance, the group's overall arrears position increased to 2.1% as a percentage of receivables from a longer term average of 1% roughly, mainly reflecting the volume growth in the retail vertical, including in the UK, which in itself still represents early stage growth performance within a new geography. As a result of this, the portfolio evidenced an overall loss rate of 2% for the half, again, which is fully as per expectations, is within our risk appetite levels, and furthermore, our expectation is that over the medium term, this will reduce and stabilize as the books mature. Okay, so then turning over to page 32 and our funding position, we are very pleased to report that all our funding facilities are performing as per requirements and are available for drawdown. As at the end of the first half, we note an overall funding runway of $173 million, with an expectation of a strengthening cash balance during the January to March quarter during seasonality, a dynamic again that we are noting during the quarter so far. This existing funding runway is as per our overall objectives, and really whilst it supports our current high growth strategy, it also supports our medium-term strategy of securing larger and more capital efficient and lower cost of funds solutions. For example, warehouse financing. We really see this as a critical path to achieving optimal allocation of our capital through having lower LVRs in the single digits and in achieving operating leverage through lower costs of funds. And it's really these funding aspects in combination that will allow us to maintain our strong margins on an ongoing sustainable basis. Okay, so finally, if we look at our balance sheet and cash flow statements on pages 33 and 34, we can really see the strong growth in receivables of 32% to 61 million at consistent loan to value ratios or LVRs, as well as a stated reduction in cash balance ending up at 39 million due to the very strong TTV performance achieved in the second quarter. As mentioned earlier, the cash balance is really a result of that peak seasonal TTV and is clearly consistent as well with other years, as can be seen on page 34, with the expected third quarter net cash inflow dynamic taking place so far in January and February. The only other balance sheet item to note on page 33 is really the intangible asset balance growth from $1.1 million to $2.9 million, which reflects our investment into the platform within the period. So in summary then, and before handing over to Brian, our first half financial results of a pre-tax loss of $25.5 million is firmly as per expectations, and with our funding and balance sheet position for continued strong growth. Overall, it's been a very pleasing half, and one which has been well in line with management expectations. And with that, that was all I wanted to say on the financials. And I would like to hand over to Brian for the next section. Thank you very much.
Thank you, Jussi. And good morning to everyone joining from that side of the world, evening for those that are on this side of the world. So I'm delighted to be speaking with you all today, having had the privilege to become Openpay's US CEO and the Global Chief Strategy Officer really about 2 months ago, and somewhat symbolically on New Year's Day. That's the day that our bright New Year sun rose onto the US market for Openpay. There's such an important role that I'm honored to be playing for Openpay, and really to take on that role during such a critical time as we transition out of this pandemic and welcome really the hope of a new normal, and also as we anticipate a spend resurgence during our US platform launch in the second half of the calendar year. And to confirm for all of you, yeah, we're on this slide 24. But before I go into the themes here, I'd like to share some perspectives with you this morning. There's really over a dozen reasons why Openpay's expansion into the US market is so important and exciting. And I'd like to categorize those for you into two major buckets, if you will. A strategic bucket and a foundational set of reasons. And enabling not just the US launch, but really our global growth. So let's start with some of the foundational reasons. Foundationally, expansion into the US brings us an entirely new level of scale, one that's needed to make Openpay a major relevant player globally. The first example of this is our platform modernization. As we Americanize the Openpay platform, we're also greatly advancing our ability to localize the platform for other markets. This enhanced flexibility strongly positions us for growth globally in other markets. Second, at the same time, we're rolling out our new global strategy focused on building a foundational level of large global wholesale partners to sell and distribute our solutions at an entirely new scale. This includes some of the biggest processors in the world who we will begin partnering with in the US before expanding into other targeted global markets. Strategically, Openpay's value proposition in the US as a highly differentiated solution, providing larger and longer verticalized plans, is not only relevant, but will fill a gap in the US market that is extremely large and high. Healthcare is probably the best example of that here in the US. And being able to deliver an impact where merchants and consumers need it most is a major reason why I joined this great company. So strong, unserved market demand is the first reason that I'm highlighting. The second reason I'd like to share with you is that the US has an ongoing and unresolved systemic, really age-old conflict between the merchants and the credit card issuers. Without regulated credit card pricing and with card issuers having historical strangleholds on the consumer via consumers' preference for card rewards, it's been left to the commercial market in the US to innovate itself out of this problem. What we'll do in the US market is much bolder than that meets the eye with our differentiated value proposition, the one that Michael and I were discussing earlier. OPY, as we're calling ourselves in the US, would be the first US company to introduce a model designed by and for the US merchants, one that'll help them boldly challenge the card companies for larger ticket purchases. We're leading merchants towards the payments alternative that they've really sought for so long. The OPY value proposition in the US has the potential to drive more revenue at scale for those merchants and could do so at a lower total cost of acquisition and processing for those merchants. It can redirect consumer loyalty back to the merchants rather than the issuing bank and the card networks. It can give merchants instant access to working capital by using the instant payment rails that are emerging. At scale, merchants would receive much more value and at a much more cost-effective level and payment solutions will be much, much more effective than the interchange-based credit card model that they're all forced to accept today in the US market. So what do you have to believe for this to be true? You have to believe that a material portion of the US market would prefer an installment payment approach to a zero interest rate over credit cards for higher dollar transactions where we focus. OPY's transparent pricing and clear stated fees and terms versus the revolving open-ended nature of credit cards is a key feature that will attract consumers who we are seeking to onboard in the US. Those consumers that are looking for more control over their financial lives. Another thing you have to believe is that given only 30 days to pay with no periodic interest via credit card, that or paying using a credit card that has a periodic interest rate pales into comparison with going with an OPY product, which gives them 12 to 24 months to pay with no interest. OPY is not limited to consumer spending. It has value propositions that go well beyond that with B2B, as Michael was talking about earlier. OPY customizes credit to the consumer's borrowing situation by considering the consumer and the merchant SKU together and offering them a fixed term, resulting in a tailored credit product that helps consumers and borrowers succeed by enabling them to repay on time, which in turn allows them to have credit expansion, and in turn for merchants creates opportunities for market expansion. Now I'd like to turn your attention to what we call the 6 pillars of success. You see that on the screen here. Let's go ahead and put that up to the 6 pillars of success slide, Jane. There we go. This is what we've laid out to describe to you how we're going to be successful in the US. And you can see we've got a check mark on the first box. The first is to recruit very strong leadership. So we've hired a highly regarded set of US executives, leaders in the payments, merchant, and banking markets. The actual individual that helped set policy for buy now, pay later and alternative payments from the Consumer Financial Protection Bureau. A leader that you'll see in a moment on the next page who was responsible for how the merchants get together in their shared organization that they all participate in. The individual who helped many of the banks on the funding side of installment products. We've been bringing in the most senior executives in the industry that touch on all of the areas that we need for success. You'll see them in a moment here. The second pillar, which is very important, is to launch a wholesale strategy with the merchants, focusing on aggregators that serve the largest merchants in the US. The third pillar is enabling large sustainable ecosystem partnerships, as I mentioned, with bank processors as an example. The fourth pillar is the Americanization of the platform to absolutely get it right, the way that the US consumer needs that product to behave and the way that the US regulators demand that that product behave. The fifth pillar in the platform in our success is tuning that product to what the merchants want and need in the US. And I want to be really clear about something so everybody understands. We're building the Americanized product, the Americanized platform with the merchants for the merchants in the US. They're participating in something called the OMAC, the Openpay or the OPY Merchant Advisory Council. The OMAC, which has already started, includes some of the most significant merchants in the US market. So they'll see this as their solution, not just a solution that's being pushed on them from the outside. The sixth pillar for success is pivoting and expanding and scaling from our existing areas of strength, including those 4 verticals that I consider our castles and moats, upon which we then can expand. Example that I like to give is a kitchen remodel. Now you need to go and buy the flatware, the new stemware, and the crystal that you want to put in that new kitchen. So let's turn now to the next page, because I'd like to introduce you to the foundational 5 people. Gary Stein is the individual from the Consumer Financial Protection Bureau. He has an incredible reputation in the United States for his prowess in regulatory as well as payments and banking. He worked with me to help develop and roll out the payment system called RTP, the new real-time payment system in the United States. Efrat Yellen, who is our new US CFO. Efrat I've known for many years. She is an incredible CFO in the fintech space, specifically for payments. Troy Carruthers, the individual that I was mentioning earlier. Troy has been a board member on those merchant advisory groups that are the consortiums of the merchants in the US, the largest merchants. Larry Wine, who was actually the CEO of Paymetric and the president of WorldPay. He has launched several very successful fintechs and is bringing to us serial fintech success in his track record. Really a strong team that you should all feel very excited to meet here virtually and in the future as we introduce them to the market. So, to summarize, we really are primed for success in the US market. And we're creating a platform that's going to position us foundationally and strategically for global growth as a result of the exciting US launch. I'll now hand it back to Michael.
Thanks, Brian. And as you have heard this morning, the first half of this financial year has delivered really very strong strategic progress and operating and financial results across all areas of our business. And this provides us with a very healthy basis for further accelerated growth in 2021 and beyond. And we see here on page 36 already the positive trend across our key metrics into January and February to date, which is great to see. So our strategy is clear and we have a track record of doing what we say we'll do. As we deliver on strategy, the value of our business we are running will staircase up, and we expect to see our valuation staircase with it. We are convinced, and now here over to this last page 38, that our buy now, pay smarter approach and our SaaS solution in B2B, plus our focus on strategic partnerships, will set us up for the next level of growth. We will work with enterprise retailers, software platform providers, and payment processors to scale our business in B2B and B2C, and with banks to continuously optimize the capital efficiency of our products, as Jussi has alluded to. We will integrate further into large business platforms with critical masses of customers accessible in one hit, if you like. And we will use product innovation to engage our customers and merchants. And we are steadfastly focused on our geographic expansion within the UK and to the US, as outlined today by Brian. So the discipline of a highly talented and experienced team in all our markets to deliver meticulously on our strategic plans and promises has the potential to position Openpay as a global provider of market-leading payments and capital-efficient digital lending services. We are very much looking forward to keeping you and our investors updated on our progress. Thank you very much. With that, we will now enter the Q&A part of this call with Jane as our moderator. Over to you, Jane. Thank you.
Thank you, Michael, Jussi, and Brian. I would now like to open up the session to questions. Just a reminder, if you'd like to ask a question, please type it into the Zoom Q&A function via the ribbon on your screen. We've earmarked about 15 minutes for questions today. So if you have a question that we don't field in the time that we have, please feel free to follow up with investors@openpay.com.au after this session, and we'll respond to you that way. And we have been fortunate to receive quite a few questions already this morning. So I'll start with one. Thanks, Danny Eunice at Shaw, for sending through a few great questions earlier today. So from Danny, congratulations on a very strong result. Fantastic to see strong return to growth in merchant numbers, up 46%. Self-onboarding has obviously helped. Can you sustain this rate going forward? And are we likely to see an improvement in home improvement, which perhaps was the only weak point, growing only 3% half on half?
Thanks for the appreciation and for the two questions. Starting with the first one, I think we have only scratched again the surface with this new kind of self-onboarding, which we enable our smaller and mid-sized merchants with based on this automation project. We have launched it only in September and have already seen a significant uptick from the 35% in Q1 up to the 46% in Q2 and for the half. I believe we will not only be able to kind of keep that number or percentage growth. I think there's potential to increase it and accelerate above the 50%. Second, home improvement has been an interesting vertical, really globally, talking with merchants in that sector. And I think the lockdowns have contributed to a quite flat development in that specific sector over the last year. We hear now from merchants in home improvement who we are talking with that they see a potential resurgence of home professionals, businesses, and do-it-yourself in this home improvement sector, as people feel more comfortable inviting friends and whoever into their houses and paying for projects they put off or haven't tackled on their own. So I think there's a good confidence in the market that the sales surge again in home improvement, and we will obviously enable it and facilitate it through our longer term and higher value plans.
Okay, so a follow-on question. We are now seeing the UK accelerate with active plans and customers' growth. You have a differentiated offering to your peers there, but do you expect the UK to accelerate at a faster rate of adoption than was in the case in Australia at the same period? Or should it grow faster given the larger total addressable market? And then, or is the focus more on differentiating further by moving into auto and health now?
It's a good question with a couple of options to choose from. Back to the strategy, really, in the UK, we have started in differentiated retail to build a strong customer base of people who we believe would be very receptive for our differentiated plan structures, particularly in these verticals, home, health, and auto. And this is the next step for us, which we are working on already and have been for a while, to enter these verticals also on the back of an FCA credit authorization, which gives us more flexibility from a plan structure and plan duration perspective. But ultimately, what we want to do in the UK market, what we have been doing well in Australia, want to be there for people who want to use our product as a smart budgeting tool. And this is equally valid in retail, where we differentiate already with our higher value and longer term plans. Take JD Sports, we are the only provider of 3-month plans, in a number of other providers at checkout who offer 6 weeks and 2-month plans, and get a lot of good volume from there already. And we will also take these customers and cross-pollinate them now over the next few months into these auto and health verticals to kind of complement our market availability there as well. And from that perspective, we see strong growth opportunity across both areas, and ultimately want to be there where our customers want to use us as a budgeting tool.
Thank you. A question on yield and net bad debt. So perhaps one for you, C. So your key metrics are best in class across the BNPL peers, with revenue yield of 8% and bad debts at only 2%. Is there a trade-off in that you are potentially losing some new customer cohorts by being more prudent than others in bad debts?
Thank you for that question, Jane. Look, I think instead of trade-off, I really see it as ensuring that we apply responsible lending criteria and really service our clients accordingly. In terms of the volumes that we see today and that we expect to see, we're very, very happy with those volumes. So yeah, I am I'm pleased with those. And look, as the third point, the responsible lending criteria and the loss rates really support our net transaction margins and our contribution margins that really keep that path to profitability very clear to us. And so we know exactly where we're going and what we need to do to deliver that. So we're absolutely happy with those. And again, making sure just that we ensure that we provide responsible lending services is the main point there. So.
Thanks, Jussi. Okay, one on the US, so perhaps for Brian now. Can you shed more light on the US strategy for the next 6 months or so, and what we can expect to see by then, particularly with regard to what your new CEO and CFO are focusing on there, and what the pipeline of merchants and customers is looking like at the moment?
Happy to take that question. So I would focus squarely on the pillars of success. So you'll remember that we laid out for you those 6 pillars. And the first one we've checked the box on, which is the leadership team. The second pillar, which you'll see is we're making very good progress on, is launching a wholesale merchant strategy, starting with the OMAC, the OPY Merchant Advisory Council. You will see some significant names on that council. You'll see participation by the merchants in designing the buy now, pay later solution that they've been looking for. I do want to note today, or this week, I think today was the last day of the conference for the Merchant Advisory Group. And if you have a chance to look at the transcripts, or if anybody could, get the material from the Merchant Advisory Group in the US, what you would see is a lot of merchants are not happy with their current buy now, pay later provider in the US. And a lot of them have reached out to us, and that's all part of our strategy to engage the merchants to design the buy now, pay later solution with them, for them. So you'll see a lot of progress on that second pillar. The third pillar, which is, you'll recall, that large-scale sustainable ecosystem partnerships, you'll see a lot of progress towards that. So in the next 6 months, we're going to deliver on those things that we've laid out for you on that pillars, the 6 pillars of success, particularly in those first 3.
We had a great question earlier this morning, which I wanted to throw in here because this is the first time that we've provided a certain set of data in a particular way. So there's some data in the pack on in-store versus online transactions split across verticals. In healthcare and auto, it's very much in-store that's leading the way. And then retail, for instance, has a much higher concentration of online transactions. So Michael, the question this morning was, do you have 2 different types of customer segments?
Yeah, it's an excellent question indeed. And I think there's a couple of main factors where these 2 worlds come together. And really starting with the perspective of the customer, in one customer journey benefiting from our budgeting tool to enable these purchases, which are important for families' lifestyle across the verticals where we are, dental treatments, investment in people's home, car safety, etc., and obviously also higher value purchases in retail. And from a merchant perspective, we are an omni-channel product. We excel in store. We can really create a great experience at checkout with our flexible plans. And we have one single customer journey to enable the experience across these multitudes of different lifestyle areas. And from that perspective, we do also a whole lot in direct marketing to cross-pollinate customers who come in through one door. It can be in-store, in a car dealership. It can be online on a checkout at Kogan's. And we understand the customer. We have now in Australia 86% of repeat customers, and we understand what they want. And we listen to them, and we cross-pollinate them from one area to the next where we can add distinct value to them. And from that perspective, very different starting points for our customers on a journey with Openpay, but it comes together quite nicely as a single source of help for the needs for a budgeting tool.
Thank you. Okay. So have some questions here. Morning, Jenny Howe from Morgan Stanley. Thanks for your questions. So the first one is probably for Michael. What do you think of the macro backdrop? And does this give you confidence to expand further offshore in addition to the US and UK?
Yeah, I believe the markets which we have been seeing and working in Australia for a while, the UK now for the last 18 months, and the US now, all give us continued strong growth opportunity. And particularly the Australian example of great growth, continued growth in these verticals where we can really differentiate, where we are the only provider or maybe one of 2 with a lot of very healthy benefits, is a great example how we want to take this into other geographies. And the UK is already well underway, and the US will follow soon. We see the opportunity across these markets into further strongly growing economies in emerging markets like Asia going forward. And what I said before, we explore B2B already as a software as a service platform, which is quite easy to roll out in other geographies, as it doesn't need a lot of funding or regulatory constraints is software as a service. And we believe there's a great future for our B2C and B2B product across the globe.
Thank you. So another question from Jenny. You say OPY is used as a cash flow management tool. Are there plans to launch financial products like savings accounts, for instance?
We have heard over the last few days that one of the other peers in the market have been doing so based on strategic partnerships. From my perspective, there's a lot of different ways how we can extend from the current service into business to consumer and business to business into other adjacent opportunities, listening to our customers where they want to use our cash flow management tools. So we have been alluding on a page in this presentation already to some areas we are working on: more bespoke loyalty, digital wallets, big data insights for merchants and customers. And obviously there's, as we have heard in this question and from other peers reporting, there's other ways how we can take it from buy now, pay later into other areas. So we have our strategy, we have our plans, and more to come, but this is for sure one way to be considered to helping customers where they want to rely on their buy now, pay later provider.
Okay, thank you. I'm keeping an eye on the time, and I think we're getting pretty close to where we felt we might end this session. So I'll perhaps just throw a couple of extra questions your way, since there are a few there that are unresolved, and then we'll wrap up. So what additional TTV could your current cost base service? I understand you are growing and you'll add to your cost base.
Yeah, we are in an excellent funding position, but you see that would be one which you can elaborate to in a bit more detail.
Thank you, Michael. I mean, absolutely. You shouldn't look at the relationship between TTV growth and our operating expense, or more the fixed cost base growth at this point in time. We have, over the last 6 months, invested in our existing platforms, as well as investing in entering the US market. So there will come a time in the near future where our cost base really starts to stabilize, and that's not too far away, which will allow us to really continue and even more continue this trend of doubling our TTV per annum with what we have today. I mean, we can already, with what we have in the existing regions today, we could significantly scale up the volume. If we're now only looking from an OPEX perspective, absolutely, we could go stronger. So don't look at that kind of going hand in hand. At the moment, it's truly the earlier stage investment to make sure that we are full capacity in Australia, and making sure that the European and then North American segments will come up to speed so that we can really leverage the growth there. So certainly there's a lot of potential to grow.
Okay, we might make this our last question. I would just say we've probably got, quite a number of questions that haven't been responded to. So please do, a reminder, feel free to follow up with us, investors@openpay.com.au. So probably a good one to end on, Michael. We've seen how Afterpay and Zip have chased growth at the expense of profit over the last year. Now the stock market is making a correction. At what point do you anticipate becoming profitable?
It's a great question. I think I just want to reiterate what we have been focusing on from the early days of setting up this business, which is really having a very, very clear path to midterm profitability with a market-leading gross revenue yield, which is confirmed now with the H1 results, which we have compared with our peers, with a 8.1 gross revenue yield metric for the first half, and also the net transaction margin following very nicely. Obviously, what we will do is to continue to proliferate our differentiated product in B2C and B2B across markets where we know we can create distinct value for customers and merchants and partners, but ultimately shareholders. And I think this growth aspect will continue to be very, very important for us to become a global provider of these smart payment and digital lending services with high capital efficiency. But obviously, we continue to focus very strongly on having the right kind of healthy profit contribution margins in place to make this a profitable business midterm. I don't want to forecast when that will be. I see us to develop our business at global scale, because this is where we can really capture the benefit of a differentiated model best and scaling. But there's a very clear continued path and focus for us on profitability midterm, and the market will appreciate.
Excellent. Well, with that, Michael, I might hand back to you for closing comments.
Excellent. Thank you very much, ladies and gentlemen, for joining this call this afternoon or this morning, depending on what part of the world you are. And it was a pleasure to updating you on our recent progress. We are very happy, as you've heard, with the strategic progress, but also the financial operating metrics, which we have been proud of presenting. And we will keep you updated on our journey as we move on, and wish you a great day, and thanks again for your support.